Hi, everybody. Jose Luiz Morales here with the Jose Luiz Morales Show and the Jose Luiz Morales team, or the Morales team. This is episode number 25. Today, we've got a very special guest. His name is Mike Skoczylas, which I'm glad that I learned how to pronounce it correctly. He's going to be talking to us about 1031 exchanges. He's a 1031 specialist. Now, the reason I wanted to bring Mike on is a lot of times I get a lot of people who are thinking about selling a property, but don't really know that when selling an investment property, there are certain tax implications if you just sell and cash out. So I wanted to bring somebody that specializes in this to really give us some light and to shed some light on the situation and what are the options that homeowners, investors, and people have when selling property. So welcome to the show, Mike. How are you?
I'm doing great. Thanks for having me on here.
Perfect. So if you're selling an investment property or considering selling an investment property, if there is a gain, there's going to be certain taxes associated with that gain. One way that a lot of investors avoid that gain is by doing a 1031 exchange, Mike. So, Mike, what is a 1031 exchange?
1031 is, just so people are clear, 1031, they didn't name it that for any good reason, other than the fact that it is the code section of the Internal Revenue Code where you find this. So a 1031 is when you exchange like-kind property for other like-kind property, and the IRS considered it as you're not exiting your investment. It's like if you held Apple stock and you're just still holding Apple stock, you're not going to get taxed on it until you sell it. So if I'm holding a quadplex in Los Angeles and I want to sell out, I would be taxed on it if I got the cash in my hand. But if I do a 1031 exchange and I buy a 10-unit multifamily in Denver, then it's as if I never cashed out, and I don't have to pay those taxes because I'm continuing my investment.
Okay. So it's essentially what happens if somebody doesn't do a 1031 exchange and they want to sell an investment property. Now, for all of the listeners out there, essentially, if you sell a primary home and you lived in it for 2 out of the last 5 years, there's an exemption where you don't have to pay any taxes. However, if it becomes a rental property and you want to sell the rental property, there are certain tax implications. What does that look like for somebody looking to sell an investment?
Okay, so let me add on to what you were saying. Section 121, which is the home exemption, it only works if your gain is $250,000 or $500,000 or less. $250,000 if you're a single, $500,000 if you're a married couple. So if you bought your home in San Francisco for $35,000 25 years ago, and now it's worth $1.5 million, you're going to owe some taxes on that. But I'll get into investment because it's a little more, when you sell the home, it's just capital gains taxes. And current capital gains taxes are 0, 15, or 20%. So most people will be in the 15 to 20% range on one of these sales. And when you're talking about an investment, you also have depreciation recapture. So you depreciated your asset, you got all these beautiful losses that you get with real estate, and you're like, hey, I'm making money, but I'm not paying taxes. This is awesome. And I know you had Yona Weiss on talking about cost segregation. He's the guy that can make that happen even better for you. But what happens is, at some point you got to pay the Pied Piper. If you sell that and you took all this depreciation, that reduces your basis, and you're going to pay, recapture rates, which is higher than the capital gains rates, about 25%. And you're going to pay capital gains rates at either 15 to 20% on that gain. Mm-hmm. And the only way to really avoid that is through a 1031 exchange. There's some opportunity zones now that are coming up, but the way to really avoid that is a 1031 exchange. You exchange into new investment property, and you're good. You avoided recapture. You avoided capital gains taxes.
Okay, and then so essentially, is there a limit as to how many times somebody can do a 1031 exchange, and what classifies as a like-kind property when doing a 1031 exchange?
Two great questions. So first is we tell all of our clients, swap till you drop, meaning keep swapping, keep doing your exchanges until you drop dead one day. The two inevitabilities are taxes and death.
Uh-huh.
But at death, your heirs get a step up in basis. So, you could swap for 50, 60 years. Your basis is already almost zero. And then all of a sudden you die and snap, you get a step up in basis to the fair market value at the date of death or 6 months after. And they sell the next day, they have no capital gains.
Mm-hmm.
So there's no limit. You could do it one time, you could do it 5 times, you could do it 100 times.
So let's say that I exchange like 5 different times, which means I'm not paying taxes on that or at the present moment, and then I die. Are you saying that once I die, I it's likely that I won't have to pay any taxes at that point, or my heirs won't have to pay any taxes?
Your heirs will owe no capital gains taxes. We could talk about the estate tax another day, but let's talk about, income taxes. Your heirs will not owe any income taxes on the capital gains if they sold the next day, because you get a step up in basis at the date of your death.
So I'll tell you guys where this comes into play. I was talking to a client yesterday, and they were considering selling their property, and their attorney basically told them, or they were considering selling their mom's property, which their mom essentially is unfortunately on her deathbed. And basically the attorney's advice was, do not sell now, wait until she passes away, and then at that point sell it because of the step up in basis. So that's ultimately what Mike means by what was
right.
that?
Swap till you drop.
Swap till you drop.
No, the truth is, it's especially if you're in California and you have federal capital gains taxes and your state capital gains taxes, you're losing a large chunk. And if I had a graph I could show you, using leverage, all of a sudden, let's say your clients were going to have to pay $300,000 in capital gains taxes, and they want to use it for another property. Using leverage, that 300 gets multiplied significantly.
Yeah.
And then essentially you're taking an interest-free loan from the government. And the more property you buy, the higher your let's say you have a cap rate of 5, you're all of a sudden earning, all this extra money that you wouldn't have because you had to pay it to Uncle Sam.
Yeah. Yeah. And that's what I tell people, that I mean, if you can avoid some of those taxes, it makes a lot of sense. So what classifies as a like-kinded property? I mean, can I sell a single family and buy a multi-unit? Can I sell a single family and buy a commercial building? Can I sell a single family and buy a piece of land?
Great. So, usually the IRS is not very taxpayer friendly. Mm-hmm. But when it comes to this, and 1031 used to be for personal property also. But as of 2017, they limited it to just real property. But the IRS is extremely lenient when it comes to real property. Mm-hmm. Any real property that is basically like kind to another real property in the United States. So U.S. to U.S. real property. You want to sell a piece of land and buy a industrial warehouse, that's like kind. You want to sell a single family and buy self-storage in Wisconsin, that's like kind. And then any foreign to foreign is also like kind. So you're buying in Germany and so you're selling in Germany and you're buying in I don't know, France, you're good.
Now explain this to me, because I had a client one time who told me, Jose, I want to sell $1 million property. I have about $500,000 in profit, and I want to buy like a $700,000 property. And he was thinking, and I think that for some reason we lost. Can you still hear me, Mike?
Yeah, I got you.
Yeah, the screen just went blank completely, so I can no longer see you. So I don't know if you want to continue the interview like this, or if you want to log right back in very quickly.
I'll log in quickly.
Sounds good. I'll wait for you. So for our listeners that are watching out there, I had a client that wanted to do an exchange, but he wanted to essentially, he was under the understanding that as long as you reinvest the profit, then at that point you can still do the exchange. And the way that it works is a little bit different. So we're going to have Mike explain that in just a quick moment as soon as he comes back on and hopefully that he can jump back on. In the meantime, if you have any questions, meaning that you have any questions that you like for Mike to answer, please put them in the comments, and we're happy to answer those questions for you guys as soon as Mike jumps back on. And the other thing that I wanted to let you guys know in the meantime is our mission here at the Morales Group is to provide free education to consumers out there. We feel that the more the consumer knows, the more empowered that they are to make the right financial decisions. On top of that, we actually practice what we preach. What I mean by that is that we invest in real estate ourselves. We own a very large real estate portfolio, and we'd like to have the opportunity to be your real estate mentor. So if essentially, if you're looking to invest in real estate or buy real estate, we want to be your mentor. And welcome back to the show, Mike.
All right.
I can see you now. Perfect.
Okay.
So what I was going to say is I had a client that wanted to sell $1 million property at about $500,000 from what he felt was profit. And he was under the assumption that as long as he took that $500,000 and reinvested it, that would be okay. Is that correct? Or what would be the right way to do it? Or how does somebody actually qualify to do an exchange?
So there are, some rules for an exchange, and ironically, it gives you tremendous benefits, and it's a very simple process, but they are very strict with the rules. And one of the rules is you have to trade either equal to or up in value. So if he had $1 million property and a $500,000 gain, he needs to buy $1 million property or more. And you have to use all the cash, and you can't get any cash from the exchange. So if he had, I don't know how much cash or debt he had, but all the cash needs to go in. Let's say he had $500,000 of equity. That $500,000 needs to go into the property, but he can get as much new debt as he wants. But he needs to trade either up or equal to in value. Okay. Because, like I said before, the IRS allows this because you're not exiting your investment. But if you're going to go from $1 million property to a $700,000 property and take out $300,000 in cash, that's considered an exit of your investment. So part of his gain would be shielded, but not all of it. Okay.
And it essentially, can somebody buy more than one property? Like, for example, like if they're selling $1 million property, can they just buy $1 million property, or can they buy 3 $500,000 properties and still meet that requirement?
They could buy 3 $500,000 properties or 7 $200,000 properties. You want me to walk through the process, or you want to get?
No, that would be great. Yeah.
Okay.
That would be great.
Simple process. Client enters into a contract to sell his land, contacts the QI, and they sign an exchange. QI is a qualified intermediary. I work for a qualified intermediary, Madison 1031, Madison Exchange. You contact me. You send us the sales agreement. We need to figure out sometimes who the actual exchanger is, because one of the rules is that the same taxpayer needs to have who sells the property needs to purchase the property. That doesn't mean you can't use a different LLC if it's just your property and you had it in Jose 1 LLC, that you can't buy your new property in Jose 2 LLC because you wanted to, you want to get rid of all your old liabilities and create a new one. As long as you are the same taxpayer in this case, because it was a disregarded entity, you're all good. So you send the sale agreement, and you and I enter into an exchange agreement, or you and Madison, and you assign for 1031 purposes the sales agreement. Everything else is the same. At closing, the only difference is on the settlement statement, it'll say Madison Exchange as QI for Jose. All the money at closing needs to come to Madison Exchange, which we hold in a segregated account with your name and a FDIC insured. We're bonded, we're insured. And then you have 45 days to identify new property, like-kind property. And there's a few rules here. You can name up to 3 properties with any 3 properties, as replacement properties, and you can buy one, you can buy two, you can buy three. That doesn't matter. If you want to identify more than 3 properties, you can only identify up to 200% of the fair market value of your old property. So in your case, you had $1 million property you were selling, and you can't decide between these 6 properties. You could list all of them as long as the fair market value of all of them put together is under $2 million. Then there's a last rule, like a last resort. You can identify as many as you want. You know, you identified 8, but they were worth 2.5 million. You're still good as long as you purchase 95% of what you identified. But that's the last resort rule. So you can identify and buy as many as you want within those rules. You know, so you identify within 45 days. You have to close on those properties within 180. And, you know, we're going to take your money and buy the property for you. You do all the negotiating, you enter the agreement, and then we have the same type of assignment agreement to say for 1031 purposes, you're going to sign this purchase agreement to us. We send the money at closing, and it's titled in your name. Title never comes in our name unless we're doing a reverse exchange, which we can get into another day. But title goes directly in your name or your LLC's name. And then the exchange is over. So, you know, you have the 45 and the 180 are hard deadlines, and your identifications need to be specific. So,
what happens if I don't meet those deadlines, Mike?
Then you don't get the 1031 treatment. Like if you, and the 45 day is actually very, very, very strict. By midnight on the 45th day, you have to identify your properties in writing, and they have to be pretty specific. It can't just be a house on Main Street. It's got to be like 123 Main Street.
Okay, perfect. And then after the 45 days, is it 180 after the 45 days, or is it 135 after the 45 days?
It's 180 days from closing.
From closing. So 180 days, the timelines start from closing, actually.
Correct.
Perfect.
Yeah. And the 45 days runs from closing, and the 180 runs from closing.
Yeah. Now, let me ask you this. Can someone do a 1031 exchange after the fact? Like, meaning like I just, like the money actually touched my account?
No. Once the money touches your account, you're disqualified.
So for consumers out there that are watching the show, if you're considering doing a 1031 exchange, it's important that the qualified intermediary gets notified throughout the escrow process. Essentially, one of the mistakes that could happen is for some reason this gets overlooked and the money goes into your account. Now there's no way to do a 1031 exchange.
Right.
So it's important that you work with people that actually understand this and that know the process so that this doesn't happen, because I mean that could be a huge mistake. And
we don't have to get involved like very early in the process, but as long as we're involved before closing, we can make it happen pretty quickly.
Yeah. What about the down payment? Like, let's say that I bought a property at $500,000. I'm selling it at $1 million. I put $100,000 when I bought it. When I'm doing the exchange, can I get my initial down payment back out? Or
you're saying that the down payment on the new property?
No, on the property that I'm selling.
No. So once you pull out money in anticipation of a sale, that's taxable, and it's what in our terms is called boot. You'll hear that in the 1031 world, and so boot is what any money that you get taxed on, any money that touches your hand, or anything that gets paid off that shouldn't have been paid off at closing. That's considered boot, and it's taxable in the year of sale.
Now, that doesn't apply for like a refinance, right? Like, let's say that I own a property, I refinance it, I take some money out, and then I do a 1031 exchange. That doesn't matter, right? Any money
that's a controversial topic in the 1031 world. Most people will tell you no. If you're doing the refinance in anticipation of a sale, then the IRS could do step transaction and say, no, you were really pulling money out and then 1031. So what a lot of people will do is they'll close on the new property and refinance. And one of the 1031 experts called it the nanosecond rule. So a nanosecond after your exchange is over, you can refi, and they won't come after you.
The new property, refinancing.
The new property, yeah.
Not the previous property. So let's say, I mean, is there a rule of thumb? Like, let's say that I own an investment property. I took money out, like, let's say 3 months ago, and now something changed in my life, and I found another property that I like to exchange to.
You're good.
I'm good. Is there like a waiting period, like a month, a day?
There's no rule of thumb. There's no official waiting period. The rule is you can't refinance an expectation of closing, because then
is the
correct. And 1031 runs a lot on intent, because 1031 has to be an investment property used in a trader business, and you have to hold it and purchase it to as an investment property. So if you had the idea of using your 1031 money for a house that you want to live in the future, and you had no intent to ever rent it out, that would be an issue. But it's all about intent. You know, intent can change very quickly, but it's all about intent at the time. So at the time of sale, at the time of purchase, what was your intent? Was your intent to hold it for investment purposes? Then you're good. But if your intent was to gift it in a week, or to move into it in a week, or something else that isn't for investment purpose, or to flip it. Flipping is not 1031 eligible, because that's not investment. It's considered inventory, and you can't do that. So that wouldn't be eligible. But if you have the intent to hold it for business purposes, you're fine. But that intent can change based on circumstances. But it's all intent at the time of purchase and the time of sale.
So another thing that I wanted to point out to the consumers, some investors use strategies. For example, they'll buy a property, they'll rehab it, they'll refinance it, get their money out, and then eventually, whenever they need to sell, they never sell the property, or they never sell and not buy anything. So they never sell and pay taxes. They always just continue doing exchanges. So an investor strategy, a lot of people think all buy low, sell high. But the thing is that if you buy low, sell high, and you don't buy anything else, a lot of times you have to pay taxes. What a lot of people do is they'll buy low, they'll fix up the property goes up in value. Once it goes up in value, they'll take their money back out through a refinance, which is a non-taxable event. And then if they ever find something else that's a better investment, then they sell it and exchange it into something else. So instead of selling and paying taxes on it, giving a certain percentage to Uncle Sam, what they'll do is they'll refinance instead. And then whenever they sell, they'll exchange. And that's actually my strategy now. My strategy is, if I ever want money out of my properties, I'm going to refinance, get that money out. And then if I ever find something that's better, I'll always exchange it into something else. And I'll what was it called again?
Swap till you drop.
I'll swap till I drop. Essentially, that's the strategy for me, because of that step-up basis. I wanted to ask you, how long does someone have to hold on to a property before they can do an exchange?
There's no rule of thumb. Again, it's all about intent. If your intent was to hold it, and I've seen, all of a sudden I intended to hold it and rent it out, and then someone made me an offer I couldn't refuse. That's a 1031. That's good. You had the intent at the time of purchasing to hold it for investment purposes. It could be 2 days. It could be 10 days. It could be 2 years. It could be 5 years. But, a lot of times on the back end, after, you've 1031 into a new property, people will tell you 6 months, 12 months, 18 months, 2 years, different practitioners, more conservative, less conservative, that you should hold it for that, unless you can show like a change in circumstances that your intent changed. But a lot of times it'll be hard to show that to an auditor, to say like, hey, look what happened. You really wanted to live here the whole time. How did that change? Well, my job changed. That could be a good answer, but otherwise, there's no real holding period rule. But what matters is that you can, if your intent did change, that you can show why it changed.
can 1031s get challenged? Like if something looks fishy, can after the fact you think that you did a right 1031 exchange, can that get challenged by the IRS?
That can. It's actually pretty rare that the IRS challenges. You're in California, not so rare that the Franchise Tax Board challenges 1031.
Okay.
Yeah. California is more on the lookout than most states. California leads the charge in challenging 1031s. But you do it right. You know, we had at the last 1031 conference, one of the guys from the senior counsel at Franchise Tax Board spoke. He says, you do it right. We have no issue. It's when you start being fishy and trying to do things and get away with things that we're going to have a problem.
What would examples of doing things fishy mean, or what would be red flags?
So California does not like what we refer to as swap and drops, or drop and swaps, really. Drop and swaps more, where you're in a partnership. You and I have a partnership. We own a building in California. We sell it for $1 million, but you and I don't want to be partners anymore. And what you can't do in 1031 is exchange partnership interests. Like I said before, and we now can only exchange real estate. Mm-hmm. So you and I don't want to be partners, but we both want to do a 1031, or I want to do a 1031 and you don't. Mm-hmm. So what we do is we drop out the interest. So now you own a 50% tenant in common interest in the property, and I own a 50% tenant in common interest in the property, and then we do an exchange. Or I do an exchange and you don't. One or the other. So California says you didn't have the intent to hold that for investment purposes because you just got it 30 seconds ago before closing. Before, you were in Jose and Mike partnership, and fine, you held that for investment purposes, but you just held a 50% tenant common interest in that apartment building for 30 seconds, and then you did an exchange. That fails the intent purposes. So California attacks swap and drop and swaps pretty often. They don't like them. There's a few other things they don't like, but that's one of the techniques that we'll do in other states. But we're very careful about in California that if you want to do a swap and drop, you got to swap early and treat it as a tenancy in common for 6 months, 12 months, whatever it is, and then do your exchange.
So essentially what I'm getting from that is that if you have a special circumstance where you're considering selling an investment property as opposed to just acting on it, it would be wise to have somebody like Mike on your team, somebody that has experience in these types of situations to run different scenarios. Now, this is something that I've seen, that somebody has an investment property and they would like to do a 1031 exchange, and essentially their goal is to rent out the property, but at some time their intention changes and they end up moving into it. It comes down to intent. I'm aware of that, but is there a certain rule of thumb of how long they would need to rent out the property before that happens? And what happens after the fact? Because I have heard of people, I've never been involved in it, but I've heard of people selling investment properties, renting them out for a couple of years, moving back into them. Does that mean that they would qualify for the tax capital gain tax exemption?
You're saying when they move back in, can they do Section 121?
Yeah, can they do Section 121?
As long as you've lived in it for 2 out of the last 5 years, then you can use Section 121. There are certain cases if I think military, health, and moving for jobs where you can get a portion of it for less than 2 years. Mm-hmm. But for the most part, if you move back in for 2 years, you can take the 121 exemption for $250,000 or $500,000.
Yeah. Now, obviously, the intention has to be, if you're selling an investment property, you can't buy an owner-occupied property, correct?
Correct. You have to have it for investment purposes on both ends, on the sale and the purchase.
So
but what we see a lot of, and I don't know how common this is in California, is you'll have a property that you'll use part for business and part for personal. So there are times where we'll do a 1031 exchange and the taxpayer is using a 121 exemption. So you can do both. So you can 1031 the business portion of your house. Let's say 25% of it was rented out to a tenant, and you have a $100,000 gain on that 25%, you can 1031 that portion and take the 121 exemption of 250 or 500 on the rest of it.
So that would be like in a situation where somebody has like a granny flat or like a duplex or like some sort of additional rental income potential. Okay.
Correct. But using one does not preclude you from the other if you qualify for either one of them or both, if you qualify for both.
Okay. Perfect. Now, this is one thing that I came across recently, and this is one thing that I wasn't aware of, and we'll touch very briefly on it. But it's called the reverse 1031 exchange. And essentially, I wasn't aware of this. And under certain circumstances, this can actually help somebody. For example, if somebody identifies a property, and let's say it's a super hot property, and they want to pull the trigger on it, but then they want to use they want to exchange one of their properties. If they have the proceeds to actually pull the trigger on the property, they can actually buy that property. So what is a reverse 1031 exchange? And
a reverse exchange is when you end up buying before you sell. So they cost a little bit more money because what ends up happening is we form a special purpose entity, and the QI has what's called an exchange accommodation title holder, which ends up buying your property. So we create this LLC, which buys the property, and then you sell your property and you buy it back from us with those proceeds. This happens if you have, like you said, if you have the funds to purchase it up front, you have to arrange the financing. But it happens often if you have like a hot property, like you said, or if somehow the sale of your property closing is delayed, but your buyer doesn't want to, or your seller doesn't want to delay closing. So, sometimes you're forced into it. Sometimes, you don't know which property you're selling. And so you can choose which of your 3 properties you're going to sell, whichever properties you're going to sell. Whichever one's going to do the most for you, but you want this property, you want to start, renting it out, start doing that. You do a reverse exchange, you get the property, and even when the exchange accommodation title holder owns it, you're still managing it, you're renting it out, you're in charge of everything. We're just in name only, essentially.
So I think the rule is that essentially you can't hold title to both properties at the same time.
Correct. So, and you can do a reverse in either direction, where either we're holding your relinquished property and then we sell it, in 45, 50, 60, 80 days, whatever it is, or we take title to the replacement property and then you sell the relinquished to pay off. So you can do it in either direction.
So in the real estate market, where this would work for you is, let's say that you find a really hot property or a seller that wants to sell but wants to close as soon as possible. You have the money to pay for that, but ideally you like to get your money back from the property. So essentially you pay for it up front, and then when you do the exchange, then you get reimbursed for that money. And it would apply on something where maybe the seller doesn't want to give you another extension. Maybe you're at a point where you've already requested 2 extensions to sell your property, and the seller, either you close on it or you lose the deal, and you don't want to lose the deal. So under special circumstances, there are times where this may work for certain investors. And what I have found is a lot of people don't actually know about this. I didn't know about this until about 3 months ago, and I've been selling real estate for 8 years, and I've been buying and selling properties. So it was something that when I found out about it, I was like, wow, this can actually help me under certain circumstances, or can help certain clients under certain circumstances.
The other scenario, your scenario is what we see 9 out of 10 times. The other scenario is when you found the property, but all of a sudden your buyer is dragging his or her feet, and you don't want to lose out on the other property, so you just got to do it, and then you sell the other one 30 days, 60 days, 90 days later. The other advantage is for up to 180 days, you can be collecting rent on 2 different properties.
Wow, I didn't think about that. So the timelines are very similar to a regular 1031 exchange, right?
Same type of timelines. Yeah.
Perfect. Great. Is there anything else that you think that our public or consumers should know about 1031 exchanges?
Yeah. The first thing that surprises most people is it doesn't cost that much money to do a plain forward exchange. We charge between $850 or $1,500. $850 for a non-interest bearing account, $1,500 for an interest bearing account. And if the proceeds are over $2 million, you have to earn interest. So you're automatically in the $1,500 range. But $1,500 in the grand scheme of saving, it could be $500, it could be $1 million, it could be $5 million in taxes. People are shocked at how cheap it is. The other thing people are surprised by is how simple and easy the process is. It's just a few documents. I said the assignment agreement, the exchange agreement. You got to provide us with the W-9. And then on the reverse, you have a few more documents. You have we're renting you the property. Look, it's a triple net lease. There's a loan agreement, but it's very simple. And it could be done a day or two before closing. We prefer earlier, but it can be done in a couple hours, really. But if you're really on top of it, but it's pretty, the plain vanilla, I'm exchanging, I'm going to identify it's quick. And we actually have 3 full-time attorneys on staff to help people hold their hands, walk them through it. Every exchange has an exchange officer who's holding their hand throughout the whole process, explaining things. And when it gets serious, the attorneys get on the phone if we need to help with some planning, but we walk people through it, and they're surprised at how easy it is and how attentive we are to the whole process.
Not only that, but I was considering doing a reverse 1031 exchange recently, and I hopped on the phone with Mike, answered my questions, ran a couple different scenarios by him, answered them to the best of his ability, and it helped me be able to make a decision. The other thing I was surprised by was his availability. It was like literally I called. I was on the phone with him right away. Here's the last thing that we forgot to touch on, Mike. And I think that this is helpful for some people. So let's say that you're in a situation, let's say I'm 60, I'm 70 years old. I don't want to deal with rental properties. At the same time, I don't want to pay capital gain taxes. So I'm in a position where I hate dealing with the tenants, but then again, I don't want to pay Uncle Sam a huge amount of money. What could somebody do in a situation like this by utilizing a reverse 10 or a 1031 exchange?
So there's a whole cottage industry of what's called DSTs, Delaware Statutory Trusts. So if someone doesn't want to deal with the 3 T's, tenants, toilets, and taxes, they can either go into a triple net. There's a lot of guys who are selling triple net leases that are eligible for 1031s, or you just go into a DST. And the DST, you are the beneficiary of the Delaware Statutory Trust, which owns real estate. The IRS has blessed it as it's considered real property, and you basically have no. You get mailbox money. It's managed by the DST company. It's considered a security, so they have to be licensed. But they get you in, and they'll whatever the return is, they'll promise you they get you that return, and they manage the entire thing. So there's a whole bunch of DST companies that can help you if you're on the day 44 and you haven't found property. That's another avenue besides the I don't want to deal with the triple T's. 44, I haven't found property. I got to stick $1 million somewhere, and I want to earn money. I want to earn something instead of paying Uncle Sam. You put it into a DST, and you can earn that money. You can earn your return, and they do a pretty decent job. They have, a lot of real estate out there is owned by DSTs.
Yeah. So essentially, and I didn't even think about it from the perspective that somebody could be reaching day 45. They haven't identified anything. They don't see anything that they like to pull the trigger on, anything that they own. They exchange it into a DST, and essentially, now what happens? Can they exchange out of the DST again and buy traditional, or once you go into the DST, is pretty much?
You can exchange out of the DST. I don't recommend. They take a percentage, obviously, of the management fee and like the buy-in. So exchanging out right away isn't, first of all, you got to have the intent to hold for investment purposes. But exchanging out of it right away isn't the greatest idea. But, if after a year or two and everything, you're all of a sudden back into the game, you found something you love, you can exchange out of them.
Okay. Cool, man. All right.
They're considered real property for the IRS purposes. So exchange in, exchange out. Usually they try to get you hooked to keep exchanging into more DSTs. It benefits them, but I don't blame them.
What happens? Like, let's say that back to the first example of tenants, toilets, and taxes. Let's say that I'm 70. I exchange my property into a DST. Then I pass away. Do my heirs still get like a step-up basis from the DST, or how does that work, or is that a completely different show?
I believe, I actually haven't seen it, but I believe they get a step-up in basis to the fair market value. I mean, that's standard tax law, that they get a what?
I was gonna say, don't quote us on this one, but
yeah, they do. I'm pretty sure they get a step-up basis to the fair market value. That's basic tax law.
Which would be great. I mean, if somebody is tired of changing their toilet, they don't want to sell and pay taxes. They transfer it into a DST, and then essentially once they pass away, they may get a step up in basis. Now, the last thing I'd like to say is this is just a disclosure. Every situation is completely different. I would talk to a accountant. I would talk to your local attorney about any of the items that you've heard on this show. This show is for informational purposes, is to really help and shed some light. The one thing I would advise all of our listeners is to have a good team behind you. Have somebody like Mike, have somebody like Yona, have a good accountant that understands these things, that deal with a lot of investors, and essentially can guide you in the right direction. I want to say thank you, Mike, for being on the show.
I 100% agree with you, Jose. I'm a little biased. I'm a CPA and an attorney. So I think you need both in your corner. And one of the things we do very well is we work with your CPAs and your attorneys. I speak both languages, so we work with them because if they're not on the same page as us, we're not all moving in the same direction. And to me, that's the most important thing, is we're all moving in the same direction for the benefit of the client.
Absolutely. Where can people get connected with you if they have any questions?
Connect with me either on LinkedIn, or you can email me at, this is a hard one because my name is not easy, as you said, skoczylas@madison1031.com. SKOCZYLAS. Not easy.
Yeah. I would never guess the pronounce by looking at that. I would have never guessed that was the way to pronounce it.
You won't be the first or the last to mispronounce it. Don't worry.
All right. Mike, I really appreciate your time, and I look
Thank you very much.
Continuing our business relationship and to send some customers your way. I really appreciate it.